Hello everyone, welcome back to the chat room. My name is Ed Ponzi. It's great to be here with you today. I'm speaking to you on Monday evening. We're in the middle of September 15th, the Ides of September, I guess. And currency markets are, it's like the calm before the storm in the currency markets. And that's why we're going to start with looking at the calendar for this week. There's so much event risk this week that almost any trade that you're in probably has some severe event risk happening to it. And you know, if you're a longer term trader, if you're playing the big playing field, as I like to say, then that's probably not a huge concern for you. I think what you need to be concerned about is if you're a short-term trader, there are several events occurring this week that you really need to be aware of. So, you know, so we've got the. I'm going to start with the calendar here. Just excuse me, just a little touch of a cold here. Still hanging on. Even as we speak tonight, okay, it's Central Bank Week. Just a few hours from this, when this recording was made, the monetary policy minutes from the Reserve Bank of Australia comes out. That could move the Australian dollar probably in a negative way, I would think, because if you hear, what we're doing is we're hearing the inside of what's going on at the Reserve Bank of Australia, and you know that those folks want to see the currency weaker. They're kind of getting their way, aren't they? They're kind of getting what they want. So anyway, so let's think about that for a minute. So if you're in Australian dollar, that's probably going to create a little bit of volatility, but that's far from the biggest one. Let's move on down the line. Wednesday, it's the Monetary Policy Committee from Great Britain, from the Bank of England. So now you're going to hear from Australia, you're going to hear from the Bank of England on Wednesday, early on Wednesday. Now later, by the way, if you happen to be in Canadian dollar, you get the Bank of Canada governor will be speaking on Tuesday. I almost missed that one. I almost let that one slip by. Bank of Canada. So every day you're going to have at least one central bank, but Wednesday is a big day. Wednesday you have the Bank of Canada, I'm sorry, the Bank of England early, and then in the afternoon you get the Federal Open Market Committee from the U.S. Now, everyone is freaking out about what might be changing in that statement. I mentioned this earlier, that if the language changes, you could see some reaction to that. The language in the statement currently states that interest rates are going to stay low for a considerable period of time. That may no longer be the case after this meeting. But you know what? It doesn't necessarily mean that rates are going up right away. It just means that they're preparing you. It's like prep. They're getting you ready for raising interest rates. So don't panic. And by the way, I believe the dollar has already been bought on the rumor. So even if this in fact does occur, you might see an initial reaction of dollar strength, but I would not expect that to last. Why? Because this has been widely reported for a week, almost a week now, that the language was going to change from the Federal Open Market Committee. So if it does change, if they remove the words considerable period of time, it might have an initial reaction, but I'm not sure it will have a huge reaction. Thursday, the Swiss National Bank. Now this affects me greatly because you know I'm long Euro Swiss, and the Swiss National Bank is basically, you know, that's my best friend right now, in that they're defending the 120 level. We did see a little pop off of that level recently, but and yeah, you know, we're up 50 pips on the trade, no big deal. But what will they say? I expect that there will be no change in interest rates from the Swiss National Bank, and they will reiterate, the Swiss National Bank will reiterate that yes, they will defend 120. They will buy unlimited amounts of currency. That there's been no change in that policy, and that should be good for us. On the other hand, if it does pull back down, I'm entirely in favor of that. I hope the Swiss Euro Swiss comes back down toward 120. So what do you think? Pretty exciting week coming up. And then, as if that's not enough, then you're going to get Yellen is going to speak. Janet Yellen's going to speak on Thursday morning. So it's just almost too much central banking activity in 1 week. And most of the currencies that we trade are going to be impacted. So just something to think about. While I'm up on this page, I want to show you that the data was very mixed today. We didn't any big move on this, but the Empire Manufacturing Index was very good. 27.5, you're looking for 16.4. That's much better than expected. But did we really get a reaction to it? If I'm going to go to Euro USD, if I can pull this up on an intraday chart, maybe we'll make it up on a 5-minute. And the number is not going to cause much of a reaction. Here it is right here, 8:30, this guy right here. Big wick up, big wick down. It's a high wave candle, right, similar to a spinning top but with longer wicks. It's not a directional candle. So the market had some good news here for the dollar, and the dollar did not rise. Right, that was a very strong number from Empire State Manufacturing Index. The dollar did not react. Now let's take a look at 9:15. A little bit later in the morning, right here, boom, Euro US dollar reacts very strongly to some news. What news was that? That was bad news. Okay, so the dollar ignored good news and then reacted to bad news. The industrial production was supposed to rise by 0.4. Instead, it was down 0.1. That's very disappointing. Also, the prior month was revised lower, and from 0.4 down to 0.2. So industrial production, think about factories creating goods, slowing down in the U.S. Does that sound familiar? Because we had similar news out of China over the weekend, and that's going to lead us back to Australian dollar. By the way, capacity utilization, what is capacity utilization? Okay, if you owned a factory, right, and that factory was operating at, let's say, 79.3% of capacity, that means you still have 20% capacity. So you could probably hire some more people if you need them. When your capacity gets to 90%, 95%, that means you probably have 3 shifts going, right? And you can't really fit another person into your factory. You're pumping out stuff as fast as you can. When your capacity utilization gets up to around 90, 95, that's when it's time to you need a bigger factory. But what's happening to capacity utilization? Just like industrial production was a big miss, capacity utilization, a big miss. We were looking for 79.3. We got 78.8. So it's interesting. The dollar chose not to react to the very strong Empire manufacturing news, but it did react to the very weak industrial production and capacity utilization news. Okay, that's usually a warning sign that maybe the dollar's a little bit overbought here. Nobody wanted to buy the dollar on good news. They used it for profit taking. So now, we're keep that in mind. Industrial production way off in the U.S., much worse than expected. Correct? Now, if I go to there's industrial production for China. Look at that. Big miss. You're looking for 8.8, you get 6.9. Now you're probably saying to me, Ed, 6.9% increase in industrial production is amazing. Well, it's amazing if you have a developed economy like the U.S. If you have a fast-growing economy like China, it's actually the worst number for that. It's the worst industrial production number in 5 years. It's hard to believe, isn't it? That's actually a very disappointing number. So what do you think about that? China, very weak industrial production. U.S., weaker than expected industrial production. Could it be possible that the global economy is not as strong as we anticipate? Bring in the OECD, Organization for Economic Cooperation and Development. What do they say today? OECD cuts economic growth forecasts. OECD urges stimulus for the Eurozone. Outlook darkens on global economy, OECD says. So what's the OECD? It's a non-government entity. It's not, it doesn't belong to any one country. And a lot of times they're late on this stuff. But it's very interesting to me. They cut their forecast for the U.S. from 2.6 GDP down to 2.1. They are based in Paris. And they said it could even get worse next year. So what are they saying, right? They went from the U.S., they went from up from 2.6 down to 2.1. For Europe, they went down from 1.2 to just 0.8, barely above a recession. And they said also Italy is going to go minus 0.4 this year. You already have Germany on the edge of a recession. It sounds like Italy might go into recession too. That's two of the three biggest economic countries in Europe. Two of them out of three on the verge of a recession. By the way, the other one is France, which is just awful. So you see how bleak it begins to look? So the only one they didn't change, they didn't change Canada, and they raised their estimates for the UK. Okay, that's very telling. We've said all along that the UK has the best developed economy, but the pound is getting mashed right now because of this Scotland referendum. You know, not only might the UK lose 8.5% of their population, they could lose a third of their land mass. Scotland apparently is fiscally fairly big. So anyway, so let's take a look at the charts and see what this means. Well, first of all, if global economic growth really does slow, which currency do you anticipate will benefit the most? I would say the yen. Now look at that chart. That is just a crazy chart on the daily. Do I want to short this? No, I don't. It looks like this activity that we're seeing right now in dollar yen is just a continuation of late 2012. Very, very similar, right? Very similar. And so late continuation 2012, late 2014, or mid 2014, beginning to look a lot like 2012 on dollar yen. I don't know if I want to short this yet, but if the OECD is correct and if these countries all slow down, we could end up buying yen. Okay, it's too soon to make that call, though. Fundamentals are going to come to bear much more slowly than technicals. Okay. All right. So anyway, we covered all of that. Now, as far as our trade, Euro Swiss, you can see it's 121.02. We had the nice pop last week. It hasn't really gone anywhere since then. I want to come back down at least to 12055 to get more. I've got a new buy order set in there, and I've got another buy order further below. So yeah, I feel exactly the same way about this as I always have, but I'm very interested to see what the Swiss say about this on Thursday. Okay. As far as the euro, euro has really taken a beating, but it almost looks as if it's trying to make a stand here. There's no bounce, though. Have you noticed that? As far off as we've come, and the euro has lost more than 1,000 points since this point right here, where we almost touched 140. Where's the bounce, gang? Where's the bounce on this euro? You would think that it should have, well, even a 38.2 bounce takes it up to 132.40. It's not happening, gang. It's not happening. Okay? The one that's most interesting, though, is the British pound. The whole Scottish referendum thing is getting out of hand. You might notice that now that this gap is filled, now it becomes an interesting short. But I have to tell you, Thursday, okay, is the day. We talked about central banks, but we did not talk about this. That Thursday, I believe, is the day that the referendum is being held for Scotland. So we only have to hear about this for 3 more months unless they vote yes. And you'll be seeing history being made if they do decide to vote yes. So here you see all day Scottish independence vote. This is huge. Gang, I'm going to just try to make a plea for sanity here. Don't try to game this, okay? Because you could get hurt really badly. If anything, whichever way the vote turns out, you'll probably see what we call a fast market. A fast market simply means that your orders aren't going to get filled where you think they're going to get filled. And the broker will probably even explain that ahead of time. So what I would say is, especially if you're short-term oriented, don't enter any British pound trades. And don't come to me and say, well, you just said not to enter, and I was going to buy, and it went up. Well, you know what? You've got your buy order here, right? And the price goes up. You think you're going to get filled here. You might get filled here. And then it starts coming back down, right? In a fast market, you can get burned really badly, okay? So this is a game of survival. You're not going to be a trader for the next 5 days or 5 minutes or 5 months. You're going to be a trader for as long as you choose to be a trader, okay? And that means use your head. Don't put yourself in a position where you could get blown up, because if you can't guarantee that that stop is going to be safe, you can't guarantee me that the price is not going to gap right past your stop. And if it does that, guess what? You're going to get burned, and there's no way you can tell me how much you're risking if you can't trust the stop. So I'm staying away from the British pound at least until we find out what happens in this election. I would say for my part, no British pound trades this week. If you feel that you must trade the British pound short term, just be out of it before Thursday, okay? But I actually highly recommend that you avoid it. Okay, had a great question about Aussie and about shorting, because Aussie's really in the tank right now. Why is Aussie getting clobbered so badly? Well, we just spoke about the reasons why. We talked about China and China's little problem that China's having with industrial production. That really hurt. And that really hurt Aussie. And you can see it really getting pounded here, right? So it's been a rough week for Aussie. And the question was, hey, Ed, what do you think about the falling price and demand for iron ore? And I think we spoke about that last week. I mean, iron ore is just crashing pretty much. Not to mention increase in inventories. Would you short Aussie USD? Yeah, man, I would. I'd short it at 92, right? Support should act as resistance. The problem is I have no idea if this is ever going to make it back to 92 at the rate we're going. Maybe, now listen, maybe the Reserve Bank of Australia will help us out. Maybe they'll be less dovish than I expect, and maybe we'll bounce off of that. But I don't know if we're going to make it all the way back to 92. If you want to try to sneak in on a short, instead of hoping for it to come all the way back to 92, I can draw in a Fibonacci here from the high to low and say, okay, how about 91.40? That's a 38.2 retracement of this move downward. You know, if this remains the low, 38.2 retracement is 91.40, so maybe we get that. But because it's so depressed, I really would like to see a significant rally, maybe some short covering rally in Aussie before I touch it. So I'm not keen on shorting it yet. I need this to rally. If Aussie can rally, then we can talk. In addition to this technique, we can also take a look at using the hourly, right? So that if RSI becomes overbought on the hourly, that could set up a short trade as well. We wouldn't really be able to tell you at this point. It's unknown at what price that trade would occur because we don't know at what price Aussie USD becomes overbought on the hourly RSI. So those are the two ways I'd be looking to play it. Three ways actually, either at 92, 91.40, or overbought hourly RSI. Any of those three, and I think I'd be happy to short Aussie right now because everything's going wrong, right? Iron ore prices are falling. China's not looking good. And even if the OECD right, the global economy is going down, which currencies are going to benefit? The yen, the dollar, and the Swiss franc, right? Your risk-off currencies. If the OECD is right, which currencies get hurt? The euro, the British pound, Aussie, New Zealand, and Canada. Okay? All right, great stuff so far, ladies and gentlemen. Let's talk a little bit about stocks because, this Alibaba is coming out in a few days. And because of that, we saw some interesting activity in the markets. Here's the Dow, right? Let's show you the Dow. INDU. The Dow, not too bad. Green candle today. Dow up 40 points. Let me show you the S&P 500. S&P 500. Tiny little red candle, but closed near it open. S&P 500 was only down 1 point. So it's nothing to get excited about. So the Dow was up. S&P 500 was break even. The NASDAQ got crushed. The NASDAQ lost 1%. That is very disproportionate. What's happening is that Alibaba goes public on Friday. And it's going to raise about $20 to $25 billion are going to be needed to buy up all the stock. So where is that $20 to $25 billion going to come from? Well, maybe someone has it laying around on the sidelines, or maybe they're taking profit in stocks like Facebook. Look at that candle. That is an ugly candle, but I am telling you something. That stock shouldn't be down like that. Okay, let's show the volume too. I don't think it's down on merit. And by the way, the volume doesn't look that bad. If I can trust it. I'm not sure if I trust that. And you're close to the 50-day moving average, and you're close to a support level here. What's that support level? 72, former resistance. I would be a buyer at 72 because you've got your 50-day moving average and you've got your support level there. So if it keeps coming down, I'd buy it. But the important thing to understand here is Facebook is not down because there's something wrong with Facebook. Facebook is down because somebody is selling shares of one speculative stock that's probably been very profitable for them, and they're unloading some of that so they can buy another speculative stock that they've never been able to buy before called Alibaba. Another name that might fit into this category is Google. Google getting really close to support and very close to its 200-day moving average. We're getting right into the sweet spot here. Somewhere around 575 or so, Google starts to become very attractive. Now the sell-off might not be over, so I won't rush into any of these. Okay, but these are the ones I've got my eye on. They're getting clobbered today, really not on their merits, but simply because traders need to sell stuff to raise money for Alibaba. So I'm looking at Facebook, I'm looking at Google, I'm looking at a few others. I'm actually looking at Yelp, which is a highly speculative name, but it just got massacred today. Look at that. Big move down, but it's coming right into its 50-day and 200-day moving averages. I don't know. I don't feel as good about this one. I mean, it's higher highs and higher lows, but not all trends are created equal. So this one's on the back burner, and we'll call it maybe, right? Now, one thing you might notice, one tech stock that they're not selling off is the Apple. And again, very close to all-time highs on Apple. You'll notice that the S&P 500 is now below 2,000, but not way below 2,000. But it's not Apple's fault. Apple's hanging in there. The iPhone 6, I know somebody who ordered one, and it's going to take 6 weeks. So demand must be high, is all I can say. If it's going to take 6 weeks, then I would assume that there were a lot of orders in place. I'd buy Apple on the 50-day moving average, by the way. That's currently 97.83. But it's interesting to me that they're not selling this one off. Okay, they are selling off Facebook, they are selling off Google, but they are not selling off Apple. Now, as far as we're concerned, we love our Apple. Our Apple's been very, very good to us. We are up more than 25% on Apple. JCPenney pulled back a little bit, but you can see we're still way up on JCPenney, between 20 and 25%, and it's just kind of bouncing along in this area. I think eventually it pops up and hits 12, JCPenney. So those two longs are wonderful. Dean Foods, it's not hurting us, it's not helping us. I don't like to see the 50-day moving average crossing under the 200-day moving average, absolutely not. But it's not killing us, okay? As far as the shorts, Kimberly-Clark is, I've said this a million times, it's right where we shorted it, pretty much. This is beginning to look pretty bleak. The 50, we're short this one. The 50 is crossing the 200 on this. And by the way, getting back to Dean Foods for a second, there was another buyout in the food area, like Annie's got bought out. The mac and cheese company got bought out last week. So maybe we're a step closer. Other companies might be better candidates like Hain Celestial and White Wave, but those companies are way overvalued. Dean Foods is pretty cheap, and I think there's just going to be a lot of consolidation in this sector, so I'm sticking with it. So back to the short side. Back to the dark side. Kimberly-Clark. That looks pretty weak to me, gang. That looks like it wants to go lower. I'll be so excited if it gets beneath this low. But there's your 50 crossing the 200. That's a beauty. Lulu has not been good to us lately, but I'm hanging in there. I honestly don't really, I just don't believe in this company. If it keeps going up, we'll have to get rid of it. But so far, it popped on earnings, and it's just kind of floating there inside day today. So I'm not going to pass judgment unless it starts making higher highs, or it could fill this. If it fills this gap, we'll be back in profit again. So let's just wait and see. I'm just giving it the wait and see. We also shorted 2 casino stocks, you might recall. Las Vegas Sands, we're short, and it just closed at that's the lowest close of the year for Las Vegas Sands. The last time it closed as low as this, 62, you got to go back to, it's been a year. So this little green candle right here, that is September 9th, 2013. So it has been, it's a 1-year low, a 12-month low for Las Vegas Sands. Thank you, Las Vegas Sands. I do not believe in the casino stocks. And Wynn is also looking like it really wants to go down. You know, we shorted it, and the first thing it did was go up. I hate when that happens. But today's close, the lowest close of the year for Wynn so far. Is it for sure the lowest close of the year? Yep, lowest close since December for Wynn. So we're short casinos, and they're just building too many casinos here in the U.S., and that's not going to work out. And we left this one alone. Whoop, not that one. MGM, not MMM. MGM, we left this one alone, but it looks like this one's breaking down too, MGM. But I think it might have the strongest business of the 3. You'll notice it's the last one to break down. So that right there is telling you maybe it's good that we left it alone, because it was the last one to give up. Okay, so that makes it the strongest of the three, and we're not playing it. Okay? All right, listen, everyone. Keep your eye out for you stock people. Keep an eye for Google or Facebook at lower levels. They might really bash these things right before Alibaba hits on Friday. So be prepared. And don't be in a big hurry to get in. If you do see an opportunity to get in, don't go all in. If you see pick some up at 72, but it's falling fast, just pick up a little bit. Maybe you get some more cheaper. Remember, they're putting these stocks on sale based on nothing that has to do with the companies specifically, Google and Facebook. They're putting them on sale so they can raise money to buy something else. And it's as simple as that. All right, ladies and gentlemen, thank you again. Please keep the questions coming in. I'm more than happy to try to answer them for you. My name is Ed Ponzi. It's great to speak with you again, and I'll be speaking to you again in just a few days. Everyone have a fantastic day. Take care now.